Hi everyone, welcome to today's Investing Masterclass with me, 𝗙𝗓 𝗂𝗏-𝗪𝗓𝗠. I'm a financial advisor and I'm joined also today by 𝗕𝗶𝗊, who is an investment manager. So I'll explain all about us and also how we work together and why we're different as well, because I think often people can mix up a financial advisor and an investment manager. And on the call today, if you've got questions, I know it sounds obvious, but if you've got questions, put them in the question and answer box. And we've got someone behind the scenes, Natalie, who will be making sure we don't miss any questions. So we'll start. And if we see questions that are sort of helpful along the way, maybe we haven't explained something quite that well, then I'll bring up the question. If not, we'll leave it to the end, and we've got lots and lots of time at the end as well for as many questions as you can throw at us. So a little bit about me. So as I said earlier, I'm 𝗙𝗓. I'm a chartered financial advisor, and I'm also a fellow of the PFS. And well, anyone who wants to learn about money, I'll talk to them essentially. And I wrote this book here, Money Lessons, in 2019. And you'll often see me in the female press too, talking about money. And this is 𝗕𝗶𝗊. 𝗕𝗶𝗊, I'll let you explain all about yourself.
Hello everyone, and lovely to be here. Thank you, 𝗙𝗓. So I'm an investment manager working at Quilter Cheviot, and as it says here, I've sort of been doing this for sort of 19 years, and I love looking after investments for clients, and I sort of do look after clients, lots of different types of people, but I really enjoy sort of looking after female clients in particular and adding value and sort of making investments sort of real and relatable. You know, it is quite jargony, can be a bit boring at times, but actually it's really important, and if you can get your head around it, it's really useful.
Well, thank you, 𝗕𝗶𝗊, for your time. So first, because we've got two sets of compliance. Yeah, we've got Quilter Cheviot and 𝗪𝐶H. This is our disclosure, which is really just that today, and I'm sure this is the same for you probably, but today isn't advice, it's just information. We want to give you lots of hints and tips, but if you do want advice, that needs to be done on an individual one-to-one basis. And then this is the same one for 𝗕𝗶𝗊 too. So I'd just like to start with thinking about money as a whole, and I think that's where 𝗕𝗶𝗊 and I differ. So I will be the one who creates a plan for a client. We'll work out what their goals are, where they are now, and then I'll go to somebody like 𝗕𝗶𝗊 and say, this client needs XYZ returns a year to achieve their goal. They've got an attitude to risk like that looks like this. They have X, Y, and Z ethical concerns if they do have them or not. And then 𝗕𝗶𝗊 creates the investments that go inside 𝗙ices or the pensions and those kind of things that we would recommend. So I think as a starting point, it's really good. And if you feel brave, you can put it in the webinar chat about where you are. You can send it just to us or, well, shout it out. But where are you when it comes to money? Do you just feel that you've got no idea and you don't know where to begin? Or you're already smashing it and really on track to achieve your goals? Most of the time, we see that people are in this sort of middle. They're ready to start, but maybe they don't know which thing to do first. So I'm going to give you some helpful hints on that. And a lot of people, before they get in touch with me, have usually done the basics, but need that boost really to make sure they're on track. So I wanted to tell you some stats about the state of UK finances. So 39% of UK adults don't feel confident about managing their money. And I get brought into lots of companies because of this. I think people could feel quite ashamed, but actually we've probably never been taught it. So I don't think we should feel ashamed. And our industries definitely like to make it very jargony. The next one is 11.5 million people in the UK have less than £100 in savings. So if you think about how financially vulnerable that means they are, that's quite concerning. And another one is 3/4 of UK people aren't on track to retire with funds to maintain their lifestyle. So we're going to give you lots of hints and tips on how you can close these gaps. So the positives are, firstly, have you got a pension that you have forgotten about or is unclaimed? 31 billion of unclaimed pensions are out there. And if you go on the .gov website, pension tracing service, you can start to claim them. As a bit of inspiration, we regularly see clients who sort of have this old pension that they've forgotten about, and it's often usually 15, 20, 30,000 pounds. But the most that I've ever found for someone who was extremely jammy was over £1 million in pensions that they'd forgotten, lost. So don't give up on them. They're definitely out there. The next one is there's £106 million of unclaimed premium bond prizes. I always hope that that's me, but it never is. So do have a look for them. And now what I really want to get across to everybody today is the power of small changes. So if you're 30 and you're earning 30,000 a year and you just increase your pension contribution by 1%, which is equivalent to £6 a week, by the time that you're 68, you're going to get 55,000, well, roughly 55,000 extra in your retirement pot. If you were 40 and a high earner at 100,000 and you did the same, an extra 1%, that would be 88,000 extra in the pot. And if you were very lucky and a very high earner, so earning £250,000 a year at 45, just 1% extra a year will give you a whopping £148,000 in the pot, which is roughly 3 times the average pension pot in the UK anyway. So yes, small changes can have a really, really big difference. So the first thing about a good financial plan is you need to know what it is that you want. There's no point just having generic goals. Most people say, oh, I would like to retire at 67. Well, actually they say 65 often because they think that's when the state pension will kick in. But have a really, really good think about what you want. And I always recommend that clients break it down into this short, medium and long. Short term is anything sort of less than 3 to 5 years. And this should always be kept in cash or cash-like things. And when you're working with an investment manager like Poppy, each year we're going to be updating her with things that are coming into that 3 to 5 year window. So she's matching the investments as well around that. Medium-term goals, and the most important thing is you want to make it a SMART goal, and always make sure you understand why you want it, to make sure that you have a better chance of achieving it. Long term is usually our retirement, or maybe it's 20 years plus, and this is a very common vehicle for saving for this are pensions. And then the medium term can be anything in between, but definitely don't invest money that you need in the next 3 to 5 years. So decide what are you saving for, what are you investing for, and allocate the right time frame. If it's long term, maybe it's pensions, if you've got allowances available. If it's medium term, a good starting point would be something like an ISA or a general investment account. And an ISA is just a wrapping around an investment that's going to protect it from tax. And the government, at least currently, until the end of next month, let's see, allows you to put £20,000 into an ISA every year. Ooh, and then this is the scariest thing that I'll say today, so brace yourself. But your long-term money goal is whatever it is that you need or want to have in retirement, you need probably 25 times that amount in your pot, which is a very scary number. And the idea being, if you've got £1 million in the pot, you take 4% out, you're going to be getting £40,000 a year. So there's 25 40s in a million. And so the idea is that you're taking down from your pot a sustainable amount, but it's also a nice number to know. So for every £10,000 you want in retirement, you're going to need £250,000 in your pot. And the PLSA, which is the Pensions and Lifetime Savings Association, sounds a cool club to be in. They say for a comfortable retirement, which they say their definition of comfortable is to be able to go to the theatre, to have 2 weeks in Europe, and to have beauty treatments. As a single person, you need £43,900 a year to achieve that, and £60,000 a year as a couple. So have a think about that number. It's never ever too early to start working out that goal. And then this is how we would manage a client's pot. So money goes into the money in account. on the day that you get paid. And if you're in a relationship, you need to decide in advance who's paying what. And you need to pay the set amount by standing order into a separate bills account. So you know whether the bill comes out on the 1st, the 15th, the 20th of the month, the money's always there in that bills account to pay it. The annual bills account, or the not so monthly annual bills account, I think is the one that tends to catch people up the most. So it's easy to pay for your mortgage, your gas, electricity, because there's direct debits come out monthly. But when it comes to like the car tax, anything to do with kids and schools can be termly. Those are the things that can trip us up. So working out all of your non-monthly bills and dedicating an amount monthly, so total amount divided by 12, and saving that into your annual bills account every month, so that when those bills crop up, you can simply just take it out of your annual bills account. Then you want to be spending some of your money in cash pot 1. So everyone wants to have, or should have, 3 to 6 months worth of cash at least in their cash pot, plus any lump sums they're going to need in those next 3 to 5 years. Pot 2 is then your retirement pot. So this is you putting money away for your retirement, making sure that you're getting the most contributions you can from an employer. Whenever we go into companies, I always see people not maxing out. So usually if you put in an extra 1%, will the employer put in an extra 1%, for example? Something to look into, the T's and C's. And then the last pot is your investment pot. And I would do it in that order as well. And a scary rule of thumb, and it is just a rule of thumb, is if you take your age and divide it by 2, so I'm in denial at 44, that means I should be putting, between me and an employer, 22% of my money into my retirement fund. So, and then whatever's left in your money in account, that's truly yours to spend throughout the month, because you've done all the right things. And then lastly, just how income tax works. So the first 12,500 you earn a 0% tax. Anything up to 50,000 and a bit, you're paying 20% tax. Above that, the 40% tax threshold kicks in, all the way up to 100. And I think this is what catches a lot of people out, is between 100 and 125,000, you pay this 60% tax. And that's because for every pound you earn over 100,000, you lose 50p of this personal allowance. And then over 125, the 45% tax threshold kicks in. So if you're in these two brackets, so if you've got kids and you're earning between 60 and 80,000, you're in a tax trap because you're losing the child benefit. If you're earning over 100 and 120,000, you're paying a huge amount in income tax because you're in that 60% tax threshold. But also now this is quite a danger zone for parents too, because of childcare costs as well. So you can use pensions to legally, and that's important that it's in bold, legally manipulate your tax. So just an example, if I was earning 60,270 a year and I paid £10,000 gross into my pension, I'm going to alter my earnings actually back down to 5270, which is going to reinstate me as a basic rate taxpayer. It's going to get all my 40% tax back, but if I've got kids, it's going to get me the child benefit. Likewise, at the top there, if I was earning if I was earning 125 and I paid 25,000 into my pension, I'm going to get all that 60% tax back as well. So that's a real whistle-stop tour, but these are the kind of things that I'm looking for when I'm making someone a financial plan. So Poppy, I'm just going to hand over to you. To talk about what's actually inside these pots, like the
I should hopefully have one more. I should be one slide back, hopefully.
Oh, sorry, too keen.
So, don't worry. So once Lisa's put together her sort of brilliant financial plan, then you might start to think about investing, and that's what I'm going to talk about today. So what I'm going to do is talk about the sort of main ways we invest, how we approach it, the magic that is compound interest, the inevitability of volatility, and why risk is not a bad thing. So what I'm going to start with is the main asset classes in which we invest, because I'm so conscious in our industry, there's so much jargon, and I'm not expecting everyone to know what fixed interest is, what an equity is, what an alternative investment is, because to be honest, why should you? You know, if you're not in this industry, sort of living and breathing it, I'm conscious that we sort of talk about lots of things that might not be people are completely aware about. So in an investment portfolio, we'd always have an element of cash, and this is separate to the sort of cash management plan that 𝗙𝗓 would have as part of her financial planning. We'd also have fixed interest, and by fixed interest, I mean government gilts, so loans to the government and corporate bonds. We would have alternatives, which is things like property funds, infrastructure, commodities like oil and gold, private equity and hedge funds. And we'd also have equity. So equity being effectively buying a small share in a company. And the way we put together portfolios is that we would say cash is the least risky, then fixed interest, then alternatives, and then equity. So when we're wanting to sort of take a little bit more risk view, we'd have more equity. And when we want to reduce risk, we'd sort of reduce the equity, increase the other sectors. And I think I also, one of the things I want to point out is that, you know, we talk about risk and it's got real negative connotations. In investment terms, you know, not all risk is bad and you have to take some risk to get some return. But I think there's a difference between taking sort of undue risk and taking risk in part of a sort of controlled financial strategy. If we could go on to the next slide, please. So I'm just going to run through each of the 4 sectors. Hopefully, you know, cash is pretty straightforward and simple, and we'd always have a little bit of cash, but in an investment portfolio, you're not going to have much. But even in a longer term portfolio, it's good to have a bit of low risk liquid asset. So you're going to get lower returns investing in cash than equities and bonds, but actually with interest rates where they are at the moment, you get 3.5%, 4%. It's not necessarily that bad for a sort of low risk investment. Then my third point is that cash is low risk, but not no risk. We do have inflation risk when you're holding cash, and I'll come on to that a little bit more in due course, but it's just to slightly bear in mind that cash is not always king. And yes, it's great to have some cash buffer, but you don't necessarily want to have all your investments in cash. Next slide, please.
Oh, sorry, I went
Don't worry.
Okay.
So fixed interest, this is the sort of next step up and often a foundation of portfolios. And I'm conscious, you say fixed interest, you think, oh gosh, how boring. But actually it's sort of, you know, it's a useful investment. And there's 2 main areas of fixed interest in which we could invest. The corporate bond, which is a loan to a company, and the government gilt, so effectively a loan to the government. And so corporate bonds, you might go and you could buy a Tesco corporate bond or a sort of Vodafone corporate bond, Glaxo corporate bonds, so all those sort of big companies sort of lend debt to people. And sort of I think one of the sort of good things about sort of fixed interest, corporate bonds, gilts is that it's relatively sort of set in what you're going to get returns. So for example, if you go and buy a sort of corporate bond, you give them your £100, they'll say to you, right, I'll pay you 5% per year for the next 15 years for this. So it's steady. You know, you're not going to get the potential of equity returns, but you kind of know where you are. And also you can buy more risky sort of corporate bonds and less risky corporate bonds. And general rule of thumb, you know, the larger the sort of return profile, the slight more risk you're taking in terms of the risk of the company you're buying into going bust. I often say sort of government gilts are the sort of almost no risk form of investing, but there's always a bit of a risk. But the likelihood of the sort of UK government defaulting on their debt is pretty low. And I think we'll all have bigger fish to fry if that does happen. But just to say, yeah, I think pretty unlikely. But then you do have moments, you know, Rachel Reeves is under quite a lot of pressure at the moment. Government gilts really suffered with the Liz Truss mini budget in 2022. So they're not no risk. There are times when they will sort of be hit, but they are relatively low risk, but you won't get as much return as you would on an equity. Next slide.
Oh, sorry, Poppy.
Don't worry.
Letting all your secrets out too early.
It's obviously a sensitive system. So alternatives. So alternatives tend to be the next step up the risk run. So alternatives cover, as I said, so commercial property, infrastructure funds, hedge funds, also now known as absolute return funds. So hedge funds seem to get a bit of negativity, so they've slightly rebranded themselves as an absolute return fund. And then commodities such as gold and oil, and things like gold have done really, really well this year, but they won't always do, and that's why we tend to sort of spread our assets. And why would you buy alternatives? You can see on the left-hand side, you know, diversify your return, generate income, reduce volatility, i.e. they shouldn't be as volatile as equities, and potential event risk hedge. And And I feel like in this industry, diversification is such an overused word, but it's so important. It's that concept of not putting all your eggs in one basket. Because even as a professional investor like me, you don't know exactly what's around the corner. Yes, we sort of look at portfolio construction theory, we make educated guesses on some things, but sometimes there are unexpected events, and that's why we'd always sort of try and spread the risk. And
one slide on.
One slide on.
Oh, here we are. Okay.
And then equity, arguably the sort of, the most risky and the most exciting of all the investments we personally would look at. And it's effectively a small share of a stock of a company. And I quite like that concept that, you might own a little bit of Tesla, you might own a little bit of Microsoft, a bit of Glaxo, a bit of Tesco, something like that. And the way we tend to buy things is that we only buy companies or funds that are listed on exchanges. So that means you can always sort of, usually buy and sell these types of things. And I think liquidity in an investment portfolio is very, very important. You don't want to buy something and find you're sort of tied up in it and you can't get rid of it. There's also really two ways of approaching equity. So you can go and buy the single share in an individual company, as I've mentioned, or you can go and buy what we call a collective fund, so a collective investment fund. So for example, I could go and look at the wide range of UK equity funds out there and choose the best investment manager out there. And I think this is particularly useful, I think, for the sort of someone who's new to investment or someone who just simply doesn't have time to read the Financial Times every day and look at, what individual stocks and shares are doing. You can sort of buy expertise via one of the big institutional mandates. And then there's also different...
Poppy, can I ask you a question?
Of course.
So, I see, I'm sort of planting a question here, but I see so many people when they initially come to me who will be almost 100% in, say, an S&P 500 fund, and that's what they've picked for themselves. So are you able to explain like what that is, what it means, and would you do that?
So you could buy something like an S&P 500 fund or what we call a tracker fund that would track one of the main markets, and that would, you're tracking the sort of largest US market. I think that's not necessarily a bad thing in terms of an approach to investment, but I probably want a little bit more diversification. So trackers are a good low-cost way of getting exposure, but I'd be a little bit cautious of putting all your eggs in one basket and just buying, one US fund. I think you'd be better spreading your equity risk a little bit. So perhaps put some in the US, some in the UK, some in Far East and emerging markets, some in Europe, because US markets have done really, really well for the last couple of years. But as I said earlier, you never quite know what's around the corner. So I wouldn't necessarily recommend just putting it in one geographical sector.
Yeah, thank you.
I think that's particularly useful why, when you're investing in a sort of a range of funds, you can buy different geographies, you can buy different sectors. You could go and buy a technology fund or a healthcare fund, for example. You could buy a small cap fund, so smaller companies. You could buy large cap. So there's so many different options out there, which is great in one sense. But I think this is also why this industry can get a bit confusing, because sometimes there's sort of almost too much choice, even for someone like me. There's an investable universe of thousands of things out there. So if in doubt, I'd say come and talk to a professional, get some professional help. So what I thought would be quite useful today as well is to just give people an example of what an investment portfolio might look like. So I've put this together. This is what we call a sort of balanced medium risk. So almost arguably the starting point for all investment portfolios, but then we risk up or risk down depending on people's individual circumstances. So for this type of portfolio, I'd say we'd have about 65% in equity, but that would be spread between UK, US, Europe, Far East, emerging markets, etc. We'd have about 15% in fixed interest, split between corporate bonds and gilts, 15% in alternatives, made up of a variety of sort of infrastructure, property, private equity, commodities, and a little bit in cash. And I think that's another important thing to say about investing. This is a sort of snapshot starting point, but it won't necessarily stay like this. And I think this is where the DIY investor can come a bit unstuck. It might be a great idea when you put it all in on day one, but if you then leave it for 5 years and forget about it, it might not be looking so good, or you might have been stuck in a sector that hasn't done so well, or an underperforming fund. So there's always that need. You don't need to check your investments every single day, but you've got to be sort of on top of things and change things when necessary. And for us, from a sort of investment professional point of view, what we would do is dial up and down the risk depending on market circumstances, how positive we're feeling, etc.
Thank you.
And then this slide, I think, is hopefully, it probably looks a little bit busy, but I think it's one of the most useful slides, and it's all about compound interest, which I call kind of pensions investment magic, but I'm in good company because Albert Einstein called it the eighth wonder of the world, and I always like to quote that because I think it's quite important. So what do I mean by compound interest? So it's the idea that you sort of invest £100. At the end of year one, it's gone up 5%. So you've got £105 to invest. So it doesn't sound very much, but actually, if you do that every year, year after year, it really adds value and it really builds. And what I've tried to demonstrate here is starting early and the benefits of long-term investment. So I've taken a theoretical return of 5% every year. That's not going to happen in reality, but I would say a 5% return for a sort of medium risk balance investment profile, that's not overly ambitious. We should be able to achieve that as investment professionals over the longer term. What I've done is, say you're sort of 25 and you're just starting investing up to age 65, the theoretical retirement age. I mean, sadly, half of us probably won't be retiring at 65, but we can dream, can't we? But effectively, it's showing that if you take your £10,000 at age 25 and invest it in this sort of relatively sensible long-term way, by maturity, at retirement age, you have £73,000. And so I think that's pretty powerful. It shows the value add of year after year investing. And I always say to people, in this day and age, it's the ultimate side hustle. Actually, if you can sort of put money away, invest well, invest it sensibly, and take that long-term view, it really will add value. And I think it really shows when you take the starting point at age 45, great, it's never too late to start investing, but you'd have £27,000 at maturity. Whereas if you started investing at age 55, you'd have just over £16,000. So it really shows the earlier you can start and the more you can add on. I think that's really useful. And I think one of my investment myths I want to sort of give here as well is you don't need to be a millionaire to start investing. I think maybe 15, 20 years ago, you needed hundreds of thousands of pounds, but nowadays there's so many different options out there. And I've used £10,000 here because it's quite nice, easy maths, but this works with £100, £500, £1,000, and also the sort of, again, a bit jargony, but what we would call pound cost averaging, i.e. putting money in every month. So you sort of almost average out potential market volatility. That's really useful if you can. And again, you don't have to have those millions to invest. And this is just going back, as I mentioned earlier, the slight risk of holding too much cash. And as I said, working with Lisa and sort of making sure you have that cash buffer, that's really important. But actually sort of not having all your money in cash, you want it to work hard for you. And this chart, I think, is quite a useful example. So it effectively takes £1,000 invested in the year 2000 and what it would be worth in real terms by 2022. So in real terms, that £1,000 would be able to buy you sort of £605 of goods if you'd left it in cash. But if you'd invested it in global equities, it'd be nearly £2,500. And that is inflation risk. That's why I said, cash is not completely risk-free. And I think it's sort of, putting aside the cost of living, I know things have really gone up in the last 5 years. But if you take your sort of £20, for example, think what you could buy now versus 5 years ago versus 10 years ago, 15 years ago. Actually, the value of money doesn't sort of stay the same. So you've got to make sure, particularly for those sort of medium to longer term pots, your money is growing with and above inflation if possible.
I think I used to have a night out on £20 in my 20s. I probably went to really rotten places.
The pubs in the city where I work, I mean, £15 for one drink nowadays. Yeah, I remember going out at university and 20 quid would do you for the night. Sadly, no longer. So volatility, I think this is a really important point to make. And what do I mean by volatility? It's really the value of stocks and shares going up and down. And when we're talking about bouts of volatility, in reality, it's shares going down. And I think I really want to reiterate to people that it's not if we see volatility when we're investing, it's when. It will happen. There will be tricky times. And it's just an inevitable part of investing. And I think what's important to say, and Lisa mentioned this earlier, is that's why we talk about investing for the longer term. If you're putting money away, it needs to be on a 5-year plus basis in reality if you're going to invest in stock markets. Because it's all about time in the market rather than being too clever and trying to time the market. And I'd also say there's a big difference between trading and investing. Trading, trying to make that short-term buck, moving in and out. Investing is for the longer term. It's very different. I think it's a more disciplined mindset. So I think it's just making sure you're clear between the difference between the two. It's sensible risk taking. It's not panicking. It's not trying to be too clever. And the reason I love this chart is it just shows, despite the fact that things are always thrown at us in investment markets, the value of investments on the whole do go up. So this is showing from 1984 to 2020 and everything that was thrown at us in that time. And I like to use the example of my career. So I started in 2006, and in that time, we've had the global financial crisis, we've had Brexit, we've had COVID, among many other things. But actually, portfolios have done really, really well over that time if you've just stuck with it. And I think often the worst thing you can do is panic and sell out, because it's sort of almost sometimes luck rather than judgment calling the lows of these kind of markets. It's really impossible to do. And I think if we look at this year, Trump tariffs, etc., when Trump sort of announced Liberation Day on the 1st of April, markets really, really fell. And it's difficult as an investment manager. It's not a fun time. But if you'd been on a desert island for April, you'd have missed it. Sort of US, UK and European markets are actually at all-time highs. So you do often get these sort of short, sharp bubbles. Sadly, they're not always short, but on the whole, lots of the sort of market volatility we see tends to be short-lived, and it's all about not panicking and sticking with it.
Lovely.
And then this chart, don't be afraid to take risks. This is really just a follow on from my previous chart of just saying to people, if you've got that time horizon, take that risk. And there's no guarantees, and I can't sit here and say markets are definitely going to go up. But if you again look at this chart, I've put 5 different asset classes on here just to sort of show you the differences. So at the bottom, in the sort of reddy maroon colour, you've got your £10,000 investment in cash. And admittedly, this is a long time horizon, 30 odd years, whatever. But your cash would nearly have doubled from £10,000 to sort of £19,000. Government gilts would be up at 30,000. Corporate bonds at 36,000, so going up the risk scale. UK equities at 48,000, but a global equity portfolio would have made you £77,000. So I think I really want to show that power of compound interest, the power of long-term investing over the longer term, because a 2%, 3% difference might not sound that much every year, but if you compound that over time, it's really, really useful. And my final slide is just to demonstrate you're probably going to have different risks for different portfolios. And that's where it comes in to sort of think about things, chat to me, chat to Lisa, work out how things fit for each individual pot of money. And I think it's part of our money psychology that we do sort of, earmark different pots for different things. So here I've got the example, shorter term, buying a house, you might put money into a sort of gilt portfolio or a very cautious portfolio, but big caveat, sometimes investing is the wrong option. And if it's that short term, less than 5 years, as Lisa said earlier, you probably ought to be thinking about a cash investment. You don't want to take that risk. Then I've got the other end of the scale with sort of pensions. And I always say, higher risk for the younger clients. So I think with pensions, people sort of have this automatic assumption that you should be super, super cautious. But actually, particularly if you're sort of younger and nowhere near retirement age, I'm 42, I'm not going to be retiring, sadly, for at least 25 years. So I've got that long time horizon. So I should be taking lots of risk. And I think this is sort of this concept of what we call lifestyling, where a pension will automatically reduce your risk as you get to retirement age. And I think reducing risk a little bit is no bad thing, but not too much, because also if we retire theoretically at 65, lots of us, particularly the ladies in the room, are going to live into their 90s. So it's not as though you're encashing that pension, on day one of retirement. It's got to keep growing and keep with you and provide an income and growth for potentially 20, 30 years. So if you haven't checked what your pension recently, particularly if you're in a workplace pension, just make sure you haven't been completely defaulted to something that's not right for you. And again, I'm not saying you need to check these investments every single day, but just being slightly aware of where it is could really sort of pay your future self effectively. Then my third option is a sort of income portfolio. And if you're living on your portfolio, if you're really needing an income, you probably don't want to be super high risk. You probably want to be more balanced, medium risk, because you don't want too much volatility if this is a pot you're living on. And this is where it comes into what we would call your capacity for loss. So it's not just how much risk you're comfortable taking, it's how much sort of money you could actually afford to lose if we saw a really negative market downturn. And so, for example, for someone like me who's sort of still working, got a salary coming in every month, I've got quite a high capacity for loss. But if you've already retired or you're not working at the moment and your sort of investment pot is what you're living on, you've got a lower capacity for loss. So again, that will sort of feed into how much risk you want to take. And then my final option I've put here is just because I feel like lots of my clients fall into this bracket, which is the sort of rainy day fund. You know, it's not a pot of money that's particularly earmarked for something, not for retirement, not for a project, but just in case. And I think this is then really dependent on you and what you want. And that goes into the sort of risk is not an exact science. And I would say you often might not really know your true risk profile till you've been invested for a little while, till you've seen a bit of market volatility, and how you sort of feel when that happens. So again, and it's also something that can be changed in an investment portfolio. We wouldn't recommend changing your risk profile all the time, but if you think, oh, I'm not that comfortable with it, or I want to take more risk, it is something that can be dialed up and down. So I'm going to leave you with 4 takeaways on investment today, if that's all right. So first one, investing is not just for the rich. Second one, risk is not all bad, and you need to take some risk to get the return. Thirdly, volatility is inevitable and will happen, so don't be too scared of it. And lastly, but not least, invest wisely as part of a wider financial plan. Thank you.
Thanks, Poppy. Thank you. So back to me, don't freak out. I really like this next chart because I think it really shows you visually why left to our own devices, we can sometimes be our worst enemy when it comes to investing. And this will be the last slide of learning, so we can start thinking about your questions. But if you look at this curve, exactly what Poppy was saying, really, something that is volatile, so it's going up and it's going down. So people start by feeling optimistic about when they invest, and often they can get excited and thrilled, and they've got, especially when they can see that their friends have done it before and have invested. Like when I joined the industry, everybody was obsessed with property, and I think this now perhaps it's crypto. And you see this point red here, euphoria. This is the point where we feel most comfortable to buy. And this is probably because we've heard a lot of stories socially, in the newspaper, on the TV, that give us the confidence that people have been making money out of a certain thing. And then as markets fall, you start to feel anxiety, denial, like this can't be happening. It won't happen, will it? Then fear, depression, panic, regret, really regretting the decision that you made to invest. And then you get to this depression point, which is the likely place that most people would sell. And then the cycle starts again, hope, relief, optimism, and off it goes. So naturally, we are inclined to buy high at this point of euphoria and sell low at the point of depression. And so I think my biggest tip for anyone that's thinking about investing is, as long as you're investing for that 5-year time horizon plus, is then to stick with the plan. Obviously review it, but don't just freak out and move into cash just because markets are falling. Can you reprogram your mind to think, well, this is an opportunity. If I believe in what I've invested in, is it an opportunity for either me to pay in more while prices are low, or to start upping my monthly contribution if I don't have a lump sum? So that's my top tip for today. So if you have a think, because obviously the most important thing about giving your time and coming to these sessions is that you actually take action. So what was the biggest takeaway that you got from today? And what's the action that you're going to take because of it? Someone's been keen with an answer, I think. Oh, we have a question, Poppy says, how can you tell if a fund is underperforming and you should actually sell? I think this is someone's also asked about their fund Smith holdings as well, whether they should keep them or switch to something else.
So all funds will be sort of, I suppose, reviewed against an appropriate benchmark. So the benchmark will be different for different funds. So if you have a UK equity fund, you might benchmark against the 𝗪𝗎 100, for example, because that might be the most relevant. So you should be able to check the fund you're in, go on to something like Morningstar, and double check where it sits in terms of, is it in what we call first, second, third, or fourth quartile? what the returns are versus benchmarks. The only thing I would say is don't maybe look too short term. I'd be cautious about selling a fund if it's underperformed over 3 months. But actually, those types of sort of providers, or as Lisa, TrustNet as well, should be able to give the performance versus the benchmark over 3 months, 6 months, a year, 3 years, 5 years, and then you can sort of work out whether you think that fund is a sort of a good option or whether there's something better out there.
Yeah, and I would, if you're tracking your money on, say, a monthly basis, sort of your assets versus liabilities, I would just put the link to your pension fund into your spreadsheet, so you can just quickly every month or every 6 months click on it just to see how it's getting on. But yeah, are you freaking out or doing the right thing is the next question. Have you got any? Are you allowed to give any views on Fundsmith? Is it a fund that you're buying?
I think that's one of those ones that's done brilliantly longer term. It's got such good long-term performance, but it has underperformed its benchmark in the sort of, I suppose, the short, medium term. So it's a tricky one. What I would do is sort of, it's a global equity fund. I would probably go and look at some other global equity funds, compare their performance and work out whether you want to switch. It's also working out where something like Fundsmith sits. If it's in what we'd call a taxable account, even if it's underperformed short term, you might have capital gains tax to pay. So I'd just be slightly cautious of that as well.
And also, I've been being asked a lot on these webinars about how does Nest pension work? How does People's pension work? And these are sort of little tiny projects that I keep trying to tick off my to-do list. So I was very proud of myself. Today I signed off the Nest brochure. It's just a 2-page thing that people can download. So look out for that in the coming months. There should be, coming weeks, and then following that there'll be a People's pension as well. I'll just quickly go to this section about how we can help, and then we'll go through all the questions in a second. So firstly is how can I help? So I do try daily, but it doesn't always work out that way, to do a video on Miss Lolly Money on Instagram. The idea being that if you just learn something every day new about money, then you're going to build that session. We also do a newsletter which comes out fortnightly, and I do a session that's called a financial diagnosis, and it's where we sit down for an hour together. You'll have pre-planned everything, and they cost between £350 and £500. And this is what it looks like. We cash flow your lifetime. So look at where you are, what you're saving, what you're investing, what it actually is that you want to get out of your goals. And you see in this example, this person's going to be fine until the age of 81, and then that shortfall kicks in. And so this person's is walking away knowing either they need a 7.45% return a year to close their shortfall, or they need to save 8,700 a year to stay on track, or they need to reduce their expectation of what they're going to get in retirement down to 23,000 a year, or they need another to make themselves richer by 100,000 nearly. So knowing those key things can often give you a really quick sense check of what you need to do and how to stay on track if you already are. So yeah, they get released monthly. They do get booked up. I think it's, what month are we in now? Yeah, November's have already gone, but December's ones will be out soon, if anyone wants one. So let me just go here. We've got a question from Stacey. Hi, Stacey, which is, how do you decide if you buy an income versus accumulation fund? And for people that don't know what that means, that's just when you look at the name of the fund, it'll say Inc or AC at the end. I'll let you answer that one, Poppy.
So I think it depends on partly what sort of wrapper you're buying it in. So, for example, if you're buying it in a pension or an ISA, there's no tax considerations in that sense. It doesn't really matter whether you buy income or accumulation. If you're buying it in a taxable account and you think you're going to, so your income's going to be quite high that year, you might want to consider an accumulation fund, and then you'll effectively pay capital gains tax, which, again, slightly caveat, but for the majority of people should be at a little bit cheaper rate than income tax. So it's not, I suppose it's not an exact science. It really depends on sort of where you're buying it. But in things like pensions, I just wouldn't worry too much either way.
So someone has very kindly said all the things they're going to do. She's got a busy end of year. pension salary sacrifice, ringing pension providers, and looking at fund and charges and change, if it's not performing well. On the salary sacrifice thing, just another shameless plug, but coming out in the new year, we've got a little short webinar, only 15 minutes, on how salary sacrifice works and whether you need to do a tax return when it comes to your pension, because I'm seeing a lot of people making that mistake. The next one, Poppy, is are there a lot of stocks held in tech industries? What sort of advice would you give about lower risk investments? I'm in my late 40s.
Lower risk investments, I would say if you're in your late 40s, you've probably, depending on the purpose of the portfolio, but if it's a pension, even in your late 40s, I'd say you can afford to take some risk, would be my personal view. Lower risk investments, great. You'd probably just buy more sort of things like fixed interest and alternatives, less equity, and also just the less risky equity. So, for example, in equity, a sort of blue chip UK FTSE 100 type sort of fund is going to be a lot less risky than buying a sort of a Chinese investment fund. So again, within that equity range, there's lots of different things you can buy that are lower or further up the risk spectrum. So I just sort of if you want to take a slightly more cautious approach, less equity and then arguably less risky equity. Don't go too crazy and try and sort of invest in anything that's too speculative or going to be too volatile.
And I think a tip to actually how you can physically do it would be if you go onto the platform you're using to invest, there's often a filter, and often there'll be a filter by risk as well. And so you can get there might be thousands of investments you can pick from, but that will help narrow it down into ones that are sort of more lower risk for you. And some of them will even ask you questions that will pop out your risk rating at the end and then show you the funds that suit your risk rating as well.
Or just go, if there's the option for buying what we'd call a multi-asset fund, so that would be something that works out what, you say you want to be low risk, low to medium to high, and they might give you an option that'll sort of invest in the sort of a proportion of equities, a proportion of fixed interest, a proportion of alternatives, and they'll do the changes within the funds. So once you've decided on that risk, you don't have to think any more about it.
Well, I think, Poppy, we may have stunned everyone into silence. So, one quickly, last minute one. Here we go. Oh, do you do financial diagnosis appointments for couples? So yes, definitely. And it's the same price whether you come as one or two. And if you're a couple, I think it's really good to do it as a couple, because then you get a plan that's meaningful for both people as well. Any last minute questions before we say bye? I think that might be it, Poppy. So thank you so much for your time. I hope everyone learned a lot. So thanks, Poppy. That was lovely.
Well, thanks for having me, Lisa. Good to be here.